Okay, everyone, thanks so much for joining us this afternoon for today's webinar titled Understanding the New Federal Legislation, What It Means for Your Business. We're going to go ahead and jump right in. We're waiting on a few people still, but have a ton of information to cover. So as you guys are all aware, a sweeping new federal bill is now law and it brings significant changes, everything from clean energy incentives to corporate and small business tax updates. Our goal today is to give you a clear, nonpartisan overview of what's in the bill, what's changing, and how it may affect businesses here in Genesee County. A couple of things to keep in mind as we get started. This session is strictly informational. We're not here to debate politics, but to provide practical guidance and resources so that you can make informed decisions moving forward. And lucky for us, we're joined by two local experts in their field who have really been digging into the information to help us all better understand these changes. There's a ton of content that we have to get through, so this information is being recorded for your review at a later time, or if you need to hop off a little bit early. We ask that you please keep yourself on mute for the duration of the presentation, and if you have questions, please feel free to drop them into the comments. We will address all of those at the end and get through as many as possible. If we still have a few lingering questions, we'll be sure to follow up with you via email following today's presentation. So with that, let's go ahead and get started. I'm going to hand it over to Gina and Joel to do a quick introduction, and then Joel's going to be kicking us off.
All right, thanks, Brianna, and thanks everyone for joining. So I am Joel Gibbons. I am a tax partner with Lewis and Knopf CPAs. I also specialize in business valuation. And then I'm going to let Gina go ahead and introduce herself after I kind of give a little breakdown of our of what we're going to go over today. So today we'll be looking at the One Big Beautiful Bill Act, which is really an extension and enhancement of the Tax Cuts and Job Act from 2017. So Trump's first administration was a large tax law change, and we're going to go over some of the changes and updates and really some new law that came into place recently. So keep in mind, this was about 1,000-page tax bill that we're going to try to condense down into an hour presentation for you. So inside of that, there's a ton of niche information and industry specific, things that are in that bill. We're going to try to keep this pretty broad. We're going to have questions at the end, but a lot of times you might want to jot down my or Gina's information if you have specific questions for your industry, because again, we're going to try to keep this pretty general. But we're going to break this down into kind of the business specific pieces of the bill and then the individual pieces that matter to you as a business owner with your employees and other associates of yours. So Gina's going to jump in first. I'll let her introduce herself, and she's going to touch on some of our business topics.
Great. Thank you, Joel. Thank you, Brianna. Good afternoon, everybody. My slides are coming up. Okay, here we go. And my background, I'm an attorney. I live here locally, and I'm with a law firm the practice that I'm responsible is specialty taxes. So we will be dealing with tax provisions of the Big Beautiful Bill for now and through the next several years. And my goal is to hopefully at least get you familiar with some of the terminology. Some of this is an extension of what we already have been working with under the Tax Cuts Jobs Act of 2017. And I think, but the big news, if we could flip, please. I think some of the big news so I'm just waiting for my screen to load. Here we go. Is that these really are business positive provisions. And so we want to focus on what you need to be thinking about between now and the end of the year on how these can help you. So I wouldn't be intimidated by the size of the bill. I wouldn't be intimidated by the name of the bill. I think we should focus on being a little selfish here on how these provisions can help you as a business owner. So that's my goal, is to make sure companies take full advantage of tax provisions that can help you grow. And some of the provisions that we're going to highlight here talk about that. So these are business provisions. Some of these are making permanent items that you've had the benefit of utilizing and expands existing expensing provisions. And there is this philosophy in the bill of phasing out some of the clean energy incentives. I have one slide at the end. Happy to do a follow-up on that topic because there's a lot of complexity on the green energy incentives. Those are still available. They're just very restricted in terms of what the focus is on domestic production with all of these incentives. So the bill aims to stimulate domestic economic growth and enhance competitiveness for U.S. businesses and workers. The second half of this, Joel, is you're going to take us to the conclusion of this and focus on how these affect your individual income tax returns. I think the one big item is that the corporate tax rate did not change. It stays at 21%. And that as far as clean energy goes, that focus is again on domestic fossil fuels, nuclear, geothermal, still clean fuels. And the other thing is solar and wind. There are still provisions in there for those types of incentives as well. There's some other issues in there in terms of when you can start to take advantage and when you must finish completion on those projects. And we'll touch on those at the very end. I think the big takeaway here is this is about U.S. production and, U.S. dominance in terms of manufacturing. And so there's a lot of foreign entity restrictions on, owners with foreign, some foreign ownership. So that's where most of the restrictions come in. Okay, so we're going to talk about 3 specific expensing provisions. And I think this is a big theme in the bill around encouraging businesses to invest now and making it as accessible as possible through tax deductions and increased limits on what those tax deductions can be. So bonus depreciation, most business owners are familiar with that terminology. So now we know that that's going to be permanent under the earlier you saw a big, beautiful bill, HR 1, the 2025 tax statute. There's a lot of names that get thrown around with this statute. But now we have bonus depreciation, which is permanent, of course, until another administration might come in. But for now, it's permanent through this act. Another piece, this is, I think, one of the landmark provisions, this new qualified production property. It's similar to what we've had in previous legislation, but this is essentially going to allow an entire manufacturing facility to be deductible as opposed to having to be depreciated. So this qualified production property provision is a very important item that we'll spend some time on. And then the 179 deduction for tangible personal property is an item that you might be familiar with. That's expanding to increase the limit from $1 million to $2.5 million. So as you can see, all 3 of those provisions, which I'll spend some more time on. The whole theme is encouraging business owners to invest in tangible property, real property, and primarily for the benefit of producing something tangible. So let's go to bonus depreciation. Essentially is exactly what it says. It allows the immediate expense for qualified depreciable assets like machinery, equipment, furniture. For purposes of this permanence provision, this is for property acquired after January 19th of this year. And there are some transitional elections throughout 2025. Again, depends on when those acquisitions take place. So you'll want to be mindful of those as you're talking with your tax advisors in terms of transitioning into, making some of those purchases. But you'd want to get on that right now, thinking about purchases you've already made since January 19th. And that you'll be making throughout the rest of this year. So I think this is a really important item to be mindful of as you start to go into this last quarter of 2025. Qualified production property. I'm super excited about this one. Just thinking about the advanced manufacturing district where we're still looking for, big manufacturers to come into the area. I'm very excited about this provision for local manufacturers, production. This essentially will allow companies to take what would otherwise be a 39-year depreciable asset and turn it into a current expense. Now, that's a lot of cost that could get pulled into a single year as an expense. But now you're not having to write that off over nearly 40 years, which makes it very difficult to recover that investment. So this new expensing provision is clearly intended to focus on large projects, manufacturing, production, essentially activities that produce a tangible products. And there's going to be a lot of regulatory language that's going to come out and describe this, but right now the language reads quite broad. And could, for, think about, some people don't think of, certain service industries like mechanical contracting or even constructions. There's elements of industries where you're producing more like producing and manufacturing versus a service. So there's going to be some interesting opportunities here that if there's an opportunity to invest or expand a current building or existing footprint to a larger footprint, this will be a nice opportunity for companies to isolate those investments and get a full expense on those costs. So similar to the timeline on the bonus depreciation, this begins for projects or construction or purchases after January 19th of this year, and the asset, the building, let's say, the factory, the plant, must be placed in service by January 1 of 2031. There are some provisions that you want to isolate and bifurcate non-production related space, but those are the nuances of this that obviously we'd want to cover in a separate conversation. Recapture, that might not be a terminology that everyone's familiar with, but this is that catch that if you change the use of this property, now what was an expense, you have to include in your income. So it's a way of saying, holding you accountable to making this investment and giving you the benefit of the expense early on, that they're requiring you to hold it for 10 years to be used in a production capacity. Tangible personal property. This is this has been around, Section 179 expense. This has been around for quite a while. What this does is allow an increase of tangible personal property from 1 million up to 2.5 million. And this could be really helpful for, just your routine business equipment and machinery, office furniture, even certain vehicles and appliances can be included. Interestingly, there are systems within a building can also be included in this provision. So you might have a commercial property that is, again, 39-year, normally has to be depreciated. You can take components of those buildings like an HVAC system or a new roof or fire and security systems. There's certain elements that you can classify, and now you can expense it as opposed to having to depreciate it over, say, 7 to even 39 years. There are some limitations, but for the big benefit here again is encouraging, improving your existing facilities, making improvements to your property, essentially investing in your business and having the ability to take it as a current expense. Now, one of the things that I want to note with these expensing provisions is that these will likely or can create what are called net operating losses. And there are going to be some limitations on the use of net operating losses, but for the most part, for small businesses, these could really become effective, that now, to the extent that you have profitable years, you're going to have this accumulation of net operating losses or tax losses that you can offset against historical or future taxable income. So there's actually a play around net operating losses that can be created around these expensing provisions. So continuing on with this theme of investing in your businesses, this research and development is an area that I spend a lot of time on. And there was a provision that, to the extent that if you were doing engineering related activities, there's this provision called 174 that before the Tax Cuts Job Act of 2017, you were allowed to expense these costs. If you had an engineer, let's say, and they had a salary and wage and they were spending their time doing engineering activities, you would expense that as a normal salary and wage. Well, you could also include those costs in something called a research tax credit, which is a very valuable tax credit that has been around since the 1980s. Well, the Tax Cuts Job Act created this provision that said, well, you can no longer expense items that you're classifying as research or experimentation. You now have to amortize them. Well, for small businesses in particular, that was very difficult to swallow, because instead of being able to expense that engineer's salary and wage, now I have to amortize it over what was 60 months. The HR1 Act, or the Big Beautiful Bill, changed this back to normal expense treatment. And this is a very important provision for a lot of reasons. One, it encourages companies to invest in what I like to call kind of value-added activities within their own operations. So these types of research and experimentation costs can be salaries and wages, outside contractors that you might utilize for some of your engineering related activities. So research and experimentation and research development sounds very fancy, but it's really not. These are sometimes kind of process improvement, product improvement. So it's a big category. And now you can go back to expensing these items as opposed to having to amortize them. You'll see here there's a carve out for foreign cost, again, with that theme of let's do it in the United States. And if you're going to do these types of activities, we all have seen where, certain types of processes and engineers are located outside the United States. So there's kind of a penalizing provision that you would have to amortize those costs over 15 years as opposed to being able to normally expense them. So be mindful of that. But I think the big takeaway here is that so now, since 2022, if you've been taking advantage of this provision, meaning in particular the research credit, tax credit, you now can carry forward those costs that otherwise would have been amortized. So now you can carry that forward into 2025, or split it between 2025 and 2026, which means you're going to have this huge catch-up deduction. Again, as I mentioned, all of these expensing provisions and now this catch-up deduction could create a big taxable loss. Great. That means you pay less taxable income, and it's an option for you to carry that forward to offset future taxable income. So there's some interesting planning opportunities there that, maybe later in the year we can spend some time on that. Interesting. This is the big takeaway. So I would highlight this provision for anyone that has gross receipts of less than 31 million. If you are a small business and you are taking advantage of the research credit or not, you have the opportunity to go back 3 years and get all of those deductions and expense them for the years that you were previously required to amortize. So that means you can go back and get refunds. These are refundable amounts for taxes that you paid in 22, 23, and 24. But those returns must be filed by next July 4th. So keep that in mind, and that's definitely take advantage of that. No need to wait until July 4th to go back and seek those refunds. I want to remind everybody that the research credit remains permanent. So it's hidden here a bit. I think my slides are off a bit, but the research tax credit has been around since the 1980s. It is a 7 to 11% roughly tax credit against your actual tax liability. So if you spend $100,000 on an engineer, let's say, or somebody that's doing acting in the capacity of an engineer, you would be able to get a tax credit of essentially $10,000 against your company's taxable income, or if it's a flow-through entity, on your individual tax return, of about $10,000. So multiply that times other people that might be working in your company, or contractors that you hire, or even costs that you incur that involve product, process, or development type activities. The good news is Michigan has not had a credit for, I can't even tell you how long. It's embarrassing that Michigan hasn't had one. Well, now starting in 2025, Michigan now has a refundable tax credit. This has nothing to do with the federal legislation, but I want to make sure all of you are aware that as of April 1 of next year, if you want to get in line for this $25 million set aside for small businesses, get ready to do that now, because these applications are a little time consuming and compliance related, but it's essentially capturing all of your product, process, and development activities and filing for that by April 1st of next year to seek that refundable tax credit. Okay, more on investing in businesses. So there's two provisions I'm going to cover here. Joel, I'm running tight. I'm going to go fast here. So hold me accountable. These are really interesting provisions, and they really focus on allowing business owners. The whole idea is to allow business owners to seek out private investment in their company without having to use traditional banking or, go to a fund to seek small business capital investment. So these are intended for private transactions between, individuals or businesses to invest in your company with some caveats here. So the first one's opportunity zones. It's been around since the Tax Cuts Job Act. It essentially allows for, or yourself, if you have capital gains, you can use that gain and avoid paying tax on that gain and defer tax on the gain that had been created to invest in a business that is in a disadvantaged, and now under the new legislation, investments in businesses that are located in rural communities. Excuse me. And then there's this other provision. It's the qualified small business stock provision. It's called 1202 stock, and essentially takes advantage of the 21% flat corporate rate that I mentioned earlier. And, this is where you want to be thinking about what is the correct choice of entity when you set up a new company, or essentially maybe even think about converting to a C corporation, depending on the type of business that you're in. But essentially, this allows for you to exclude up to 100% of your gain, to the extent, depending on how long you hold the stock, for businesses that are under $75 million in terms of their gross asset value. So these two provisions are all about giving small businesses another avenue to attract investment into their companies. Opportunity zones. I don't want to spend a lot of time on this because it really is focused on the investor into a business. But again, you can take an existing business that happens to be located in an opportunity zone, and you can seek out external investments to help you with additional capital that you might need, or maybe just a good partner that you want to bring into your business. And they can bring those investments into an opportunity zone located business or property, as long as there's going to be some substantial improvement used on the property side or an intention to grow the business in that opportunity zone location. The opportunity zones are throughout the state of Michigan. They're going to get reimagined, if you will, starting in 2027 with a focus on rural developments and agriculture, which was excluded in the original legislation. So this is going to be interesting to see how this rolls out. But the big takeaway here is that if you were to bring somebody in who had a capital gain and brought, let's say, $100,000 into your business, and they held that investment in your business, and then there was some type of a sale or exchange in the future, there would be zero tax on the appreciation of that investment in your business. Same for property. If you make improvement on real estate that is in an opportunity zone location, to the extent that you substantially improve that property, in 10 years from now, under the old law, you would have no gain on the sale of that property. So the new provision, opportunity zone, essentially provides some what are called basis step-up rules starting at 5 years as opposed to the 10-year, and expands this provision for rural opportunity funds and or investments. There's going to be I think this is a positive improvement to this provision where they're going to require new reporting requirements. We don't have those yet, but that's essentially to show that you are creating jobs in that location, and or that investment that was made was intended to reduce poverty in that geography. The qualified small business stock is really interesting. It's essentially a way to exclude, similar to opportunity zones, to exclude your tax gains if you were to sell, exchange, or dispose of that stock some years down the road. So the idea would be initially that you could, if you had set up your company as a C corporation or converted into a C corporation, you would then be in the future, to the extent that there was a sale or disposition or an exchange, you would be able to exclude the tax that you have to pay on the gain from when the stock was issued to the date of the sale. And so what this new qualified small business stock expansion did was essentially allows there to be kind of a staging of, instead of waiting for 5 years to be able to take advantage of that, you now can take advantage of that after 3 years. So again, this could either be your own, like you own the stock yourself, or if you bring in an investor and say, hey, you issue stock to them in exchange for some type of investment in the company. They stay in the business as an investor, if you will, for 3 years or more. They can exclude then when they leave, or if the business sells, they can exclude up to 50% of the gain on the appreciation of that stock, essentially the appreciation of the business. If held for 3 years, 4 years, you get to exclude up to 75%. And after 5 years, you can exclude up to 100% of the gain. So there's a cap on it up to, it's 15 million. I think I have 10 million in here. That's a mistake. That should be 15 million for 2025. So again, expanding these provisions to allow for investments in small businesses, and this is for businesses under 75 million in gross assets. There's some service-based company exclusions, if you will. So Joel and myself, financial services company, hospitality, things like that, we're not able to take advantage of these provisions. Again, this is really they're focusing on companies that are manufacturing, like building tangible goods. Think about it that way. And they did expand it to include agriculture as well. There's a lot with qualified small business stock. I'm going to leave these for just kind of consideration. It can be rolled over into some tax-free replacement of other qualified small business stock. You can roll it and combine it with qualified opportunity zones. Interestingly, for business owners, I think this should definitely be part of estate and gift tax planning. It's such that now that we have under this new legislation, the exemption from estate and gift taxes was increased to 15 million for individuals and 30 million for married couples, which sounds like a staggering number. However, you can also now transfer this stock into trust for heirs to preserve that exclusion of the gain for future generations and for future sale of the business. This is another one of those where we've had business interest deductions. Essentially, this change allows for the expansion of the base against which you measure the amount of the deduction. So there was a provision, people might be familiar with EBITDA. It's earnings before income taxes, depreciation, and amortization. So this business interest deduction is based on a formula that is derived around EBITDA. The new legislation essentially simplifies the definition and allows you to have a broader base against which you can apply this formula, the 30% of your adjusted taxable income formula, to determine what the max limit deduction can be. So essentially, this change allows for a greater portion of your interest expense that can be allowed to be deducted. So, I mean, all of these provisions, these expensing provisions, these investment provisions, the expensing ones in particular, I think, keep in mind, you could be creating some net operating losses. And so it's about thinking through which of these provisions do you need, elect into, or not need, that because you could be creating net operating losses that, again, can be used for future tax years. And then this one here, qualified business income, and I think this will probably take us into Joel's, kind of where you're going to spend your time on the individual side. But I think what's important here is that this has now been made permanent, which allows for easier planning for yourself and for your CPAs to be doing your tax return, but essentially allows up to a 20% deduction up to 20% of deduction based upon the business income. And this is for flow-through entities. So this can be, a huge deduction amount to offset what you ultimately are going to be paying tax on. For smaller business, we now have a minimum $400 deduction. As you can see, C corporations are not eligible. So again, depending on what type of entity you are, like if we talk about qualified small business stock, this provision would not be available to you. Another thing is here, there's limitations on that 20% amount that you can, or up to 20% amount that you can deduct for specialized service trades and businesses. And the idea here again is, to the extent that you're relying on someone's personal skill, Joel, myself, our skill, or people that we work with, there's going to be restrictions on how much basically it reduces the amount of that 20% against taxable income. And I say here, all I could think of was the Taylor Swift and Travis Kelce example of, arts and performing arts. They're going to be limited and excluded altogether. For people that are high earners, are not going to be able to take advantage of this provision at all. I think it's around 400,000 or 500,000 in taxable income where you kind of cap out to being able to take this deduction. And I'm gonna, I just want to highlight here, I'm happy to come back to this if we have some time at the end. This is just to note, this is kind of showing green energy, what we saw in, the Inflation Reduction Act and the previous administration. A lot of those have been restricted, eliminated, reduced as a result of the new administration. But some of these provisions remain. And so it's really dependent on the type of activity or the type of production or services that are being provided. There remains a production credit, which is very effective in that it allows manufacturers to actually transfer. In other words, you can actually, if you create a credit for, let's say, solar, wind, other green energy technologies, if you're in that industry and you have a component that you're producing domestically, you can actually create a credit. And even if you can't use that credit, that can then be fully transferred for cash, so that another person can use that credit and you can actually receive cash in exchange for that credit. So it was meant to be a way to privatize, if you will, the transfer of credits. So that provision remains. There's, again, a lot of rules around that, but just if you're in that industry, they still remain. There are restrictions in place, but we do still have some green energy credits. They're just going to be a little stingier in how they are implemented. So with that, Bill, Joel, I don't know if you want to cover it all on the QBI deduction, but go for it.
All right. Well, thank you, Gina. And yes, I appreciate it. I'll bring my slides up. Hopefully everybody can see here. So yeah, I appreciate you putting the QBI there towards the end. I feel like that's the perfect kind of segue between a business owner and the individual. And I'm going to talk a lot about individual provisions here, but it is related to us as business owners. That QBI deduction, that's been around since the Tax Cuts and Job Act. But I wanted to point out that a lot of the provisions that Gina discussed, the Section 179, the 100% bonus depreciation, that applies to your C corporations as well as your S corporations, partnerships, flow through companies. I would believe a majority of the people that are on the call are probably small business owners that have flow through type entities. At Lewis and Knopf, I would say probably 90% or more of our client base of business owners are pass through entities. So that QBI is huge for them, that's permanent, that 20% deduction that they are able to get now. So, all right, so I'm going to jump right in on the individual side of things a little bit. Again, contact information, Gina, I'm sure you feel the same way. People, you can reach out, email, call with questions. We're trying to hit on a lot of topics here, and you might get a question that we're not able to cover today, but there's my contact information and a very generous 10 or 15-year-old picture of myself. So if you don't recognize me when you see me, there's a lot more gray hair up here now than that picture had. But all right, so I'm going to jump right in. So some of the provisions here I'm going to talk about, a lot of it has to do with the Tax Cuts and Job Act of 2017 and what enhancements we are really getting now. So the first one here is the permanent extension of the 7 tax brackets that we've had for the past, 8 years now, really. And I've got permanent in quotations there because to me that's always funny. They call it permanent because there's no end date, but we know that if a different administration comes in and changes, we may see different tax rates. But for now, there's your 7 tax brackets. Key ones to point out: there's a jump from the 12% to the 22% bracket. That's a big jump. There's also a big jump from 24 to 32%. So hopefully you're working with your accountant, your CPA, to look at managing where you fall in these brackets and what you can do from year to year to manage that. It's important to point out too that some people have a misconception that once you cross, a dollar threshold, that all of your income is taxed at that percentage. That's not true. It's a graduated system. So you work your way through each of these brackets as you go. But these will be indexed for inflation moving forward, and those are the tax brackets that we're working with. The next piece is going to be an increase to our standard deduction that happened back again in 2017. It was just about doubled at that time. Really elevated what our standard deduction is. Those are also made permanent, so and increased as well. So for 2025, you'll see the single filers there have a $15,750 standard deduction. Your married couples will have $31,500 standard deduction. So those are pretty high levels. Those will be adjusted for inflation moving forward as well. And then another key component there at the bottom, this is really great for our senior citizens. So from 2025 to 2028, there is a $6,000 extra deduction on top of the standard deduction for being 65 years or older. So for a married couple that are both 65 and older, that's going to be $12,000 of additional standard deduction on top of the $31,500. So you see some pretty large deductions here overall. Again, I want to just point out a lot of this tax bill really is great for business owners and great for individuals. There are going to be some negatives that are built in there for certain things, but a lot of this is very positive as far as being a business owner and your individual tax situation. So the next one I want to talk about is the child tax credit. So again, been in place for years. Actually, pre Tax Cuts and Job Act, it was in place, but those amounts increased at that time, and they are increasing again. So now the credit for a 16 and younger child dependent is going to be $2,200. It used to be $2,000. The refundable piece of that is going to be $1,700, where that used to be $1,500. So that is in 2025, those new amounts come into effect. And then it's important to point out too that once your child does reach 17 and they're still in college, they're still a dependent of yours, there is a $500 other dependent credit that you're able to get. And something to point out too, keep in mind is the other dependents can be people like, parents that have health issues and are forced to move back in with you, or you're providing more than 50% of their support, grandparents, things like that. There's also a $500 credit for other dependents of any kind where you are providing their support. You'll see a lot here. There's phase outs. So a lot of these provisions have phase outs for high income earning individuals. So I'm not going to hit on a lot of those, but you'll see in my slides there are phase outs in here. One little negative here, it's not much of a big negative because it's been this way since 2017, so it's not a big change, but there are no miscellaneous itemized deductions any longer. So things like your tax prep fee, your advisory fees on a financial, account, any employer expenses if you're buying things for work and not being reimbursed by your employer, those are not deductions. That's a misconception. A lot of people want to give us that information, but those are no longer deductions, and they haven't been since 2017. So this is just making that permanent. Another good incentive here, this has been around. So educator expenses, they are allowed a $300 above the line, so above the standard deduction, $300 expense. What this new bill has done is expanded who can use those. So it used to really be mostly just teachers in the classroom buying supplies and not being reimbursed for it. This has expanded that to be counselors, principals, even your coaches and athletic directors and any student aides. So anyone who's in the educational field and is spending money out of their own pocket can use a $300 above the line deduction here, and that's for 2025. The next slide even adds on to that. So in 2026, not for 2025, but it's starting in 2026, if you spend in excess of the $300 cap, you can also use some of this towards your itemized deductions. So itemized deductions work if you gather all your itemized deductions and they exceed your standard deduction. So that is when this amount, if you spend over the $300 cap, it will move into your itemized deductions to be to be looked at to see if you will get the benefit of that. So in my example here, someone spends $600 on educational activities not reimbursed. They're going to have the $300 above the line deduction, and then also have $300 that goes towards their itemized deductions. So again, that's going to be starting in 2026. So that does not apply for 2025. Another small negative here, and this again is only for high income taxpayers, and this literally means the highest tax bracket. So the individuals that would be over 630,000 of taxable income. For a married couple, it's over 750,000 of taxable income. Not going to get into the formula here, but the key detail is if you're in the highest tax bracket, you get about a 5.4% reduction in your overall itemized deduction. So you get a little bit of a haircut there if you're the highest earning tax bracket. And that is going to go into effect in 2026 as well. All right, this is a big one that I want to spend some more time on. This is the limitation on state and local taxes, abbreviated as SALT. So your SALT taxes on your personal tax return. This was a major change that hurt a lot of people that had been itemizing deductions in the past. With the Tax Cuts and Job Act, your SALT taxes were capped at $10,000. So that means your state income taxes you pay when you file your tax return, your Michigan taxes, means your property taxes on your residence, your second residence, any second homes, any investment properties you have, the property taxes, as well as things like vehicle registrations. If you have local, city of Flint taxes, all of that gets grouped into a bucket, and it was capped at $10,000. So most people will just reach that $10,000 cap towards their to try to exceed the standard deduction, and they were not making it. They were capped at $10,000. So this bill increases that to $40,000. You see, that's a very large increase here. There are some phase outs there. So if your income is between 500 to 600,000, you start to phase back down lower and lower. But even if you exceed the 600,000 of adjusted gross income, you still get the $10,000 floor. So at the worst, you're still where you were, prior to this bill. So this starts in 2025, and you will be able to deduct up to $40,000 of state and local taxes. So this is a pretty major piece of this that is going to be very beneficial for a lot of taxpayers. So I've got a note down at the bottom. I don't want to get too deep in the weeds here, but this is where you would talk about pass-through taxes. So in Michigan, that's called the Michigan flow-through entity tax. And I would estimate from our client base, probably more than half, more than 60% maybe of our clients that were small business owners took advantage of the Michigan flow-through tax. That allowed the business to pay their state personal taxes and take that as a deduction for IRS purposes. So for the state, basically was a wash. But at the IRS level, you would get a deduction for those state taxes that were paid and be paying less in federal taxes. So definitely something that we tried to do to help all of our business clients, business owners, and it's still going to be very important, but it's become a little more complex now, because now you can deduct up to $40,000 at the individual level instead of that $10,000 cap. So important, reach out to your accountant, discuss that. Major change here with this tax bill. All right, the next two that I'm going to talk about here are the most publicized, I think, of this bill. It's the no tax on tips and the no tax on overtime. Getting questions all the time on this. Our business owners are getting questions from their employees about overtime and tips, things like that. So the first one here, no tax on tips. From 2025 to 2028, there is a new deduction for up to $25,000 of tip income. You do not have to itemize, so this is in addition to your standard deduction. Any of your tips, that you make for the year, up to $25,000 can be reducing your taxable income. Again, there's phase outs there. If you are a high income individual that's still getting tipped, it could be your spouse is high earning and you're in a tip occupation, but those phase outs start to apply. But other than that, it's for employees and even independent contractors that are getting tips. An example would be DoorDash. If you're 1099 from DoorDash, but you're getting tips, that is still tip income, and it will segregate out how much is tips and how much is your base pay. So the IRS is going to give us some more guidance on this. This is new. They're going to have to update how it's reported on W-2s and things like that. They're supposed to give us more guidance by October 2nd. But I highlighted one word on here, and that says voluntary. So this is key for you if you're a restaurant owner, things like that, to keep in mind. it has to be a voluntary tip. So for an example, if I go to a restaurant and I have a party of 10 and it says, parties of that size, automatic gratuity is included. That is not voluntary. That is part of the bill. So that needs to be broken out and not shown as tips. That would not be part of this deduction. I have restaurants or bar owners in college cities that college kids weren't tipping. They were just leaving their tab and leaving the bar. So they've put in, automatic gratuity on their bills. That's not going to apply here for the tips. So business owners have to be cognizant of that. They have to be careful with that. It is voluntary. And again, we need to get more guidance from the IRS on that. Next piece is the no tax on overtime, is very similar to what I just talked about with the tips. It's 25 to 28. It is qualified overtime compensation, and you do not have to itemize, so it is a deduction above the line. The one difference here is an individual, it's only $12,500 that is allowed to be deducted here. If you're a joint filer, it's $25,000 for that overtime compensation. And the key I want to point out here too is it's only the overtime piece. So if your example, an employee is paid $20 an hour and their overtime is $30 an hour, well, the $30 is not the deduction that can be taken away for overtime. It's the $10 difference. So it's the overtime compensation piece. And again, on the W-2, it's going to have to break out and show how much is that actual qualified overtime compensation. So those are two of the most kind of advertised pieces of this bill. The next one, this is a great, again, a lot of this is really advantageous to our business owners and our, the individuals at the individual level. This is no tax on car loan interest. So this is also from 2025 to 2028. It is for personal use vehicles. So sorry, it's not if you're buying, through the business. But here at the individual level, there's a couple caveats. It has to be a U.S. assembled in the U.S. vehicle, and it has to be a new vehicle purchase, not a used vehicle purchase, a new vehicle purchase, and it has to happen in 2025 to 2028. So if you have a U.S. vehicle that you bought 2 years ago in 2023 and you're still paying interest on it, it's not going to apply. It has to be bought in 2025 to 2028. But other than that, it's fairly straightforward. It is an above the line deduction. There's a max of $10,000 a year, but your auto loan interest will be a deduction for you. I'm going to breeze over this one quickly because of the time, but there are Trump accounts it's to incentivize people putting into retirement for their children. So I'm just going to point out the pilot program for this. If you go to a financial advisor and say, I'm going to set up a Trump account for my child and put $1,000 in there, your child, again, has to be born in 2025 to 2028. If they are born in those years, which I have a daughter who was just born in 2025, I can put $1,000 in there, and when I file my taxes for this year, I get $1,000 back. So it is free money from the federal government to put into a retirement account. Now that turns into an IRA basically, where that child should not get that out before they reach retirement age. But it is free money from the government. So again, I'm going to go through it quickly in essence of time that we have here, but I'm going to breeze through this one as well. The adoption credit, this has been in place for years and years. It's a lucrative credit, very big credit, but the change now is you can get $5,000 of that refunded to you. People have had adoption credits for sitting and carrying forward for a long period of time because it would only offset tax that they owed. So they're sitting and waiting to have that recouped. Now you can get $5,000 a year refunded to you. So that's going to help those people get that money a little bit faster. This is enhancement of the child and dependent care tax credit. So this has been in place, but the maximum percentage was 35% in the past. It is now increased to 50%. So another great increase for people. The phase outs happen pretty quickly, but you can see here you can get $3,000. This is if your child is in daycare while you're working. This is basically helps you recoup that cost. So $3,000 for one child, $6,000 for 2 or more children. So some enhancements there. 529 accounts. Sorry, I'm going through this pretty quickly here because we are getting lower on time, but 529 accounts. I just want to point this out for our business owners that the changes that have been made here that can be very advantageous is they've really broadened the list. So my example I want to just give quick is licensing and continuing education. If you are paying for that, if you're a real estate agent and you need to pay for licensing on a regular basis, well, you can, if you have a license that's $400, instead of just paying that fee, $400 expense, you can contribute 400 to a 529 account, turn right around, take that money out, pay your $400 expense, and you will get a $400 deduction at the state level. So 529 plans used to just be for college expenses. They have been broadened to anything. I mean, it's a huge list here that can be very advantageous and save you some money tax wise on your state taxes. Not talking big money, but anything that saves in taxes is great with me. The next piece here is the charitable contributions. So this is the above the line. So even if you do not itemize, you are able to take a little bit of your contributions each year. In 2025 and previous years, that was $300 for a single filer, $600 for married filing jointly. That is going to increase in 2026 to $1,000 for single filers, $2,000 for married filing jointly. So gives you a little bit more incentive to give charitably if you even aren't itemizing. My last two slides are going to be some little negatives for us. So they just showed you how they increase the above the line contributions, but here they're taking a little bit away for those of us who do itemize and are very charitable. So there is a new, in effect in 2026, there is a new limitation. 0.5% of your AGI, your adjusted gross income, is not going to be allowed to be used in the year for your contribution. So it's going to reduce down the amount of your contributions that go towards your itemized deductions. The good news on this slide is that piece is not lost. It will carry forward into the next year and will add on to whatever contributions you made then, and then it'll go through the calculation again. So just a small little negative here. And then my last slide before we get to some questions is going to be the termination of the clean energy and vehicle tax credits. Gina touched a lot about how, what incentives are out there for some of this clean energy stuff. These, I've got the dates highlighted here, so I think it's very time sensitive. So we've got about 4 weeks. If you are thinking about getting an EV, a used or a new EV, you've got to do that before September 30th to receive a $4,000 tax credit for a used vehicle, $7,500 tax credit for a new vehicle, EV purchase. If you do not purchase before September 30th, that credit will be gone. You will no longer have those tax credits for EV purchases. And the last one I've got here is your energy efficient home improvements. So your windows, insulation, HVAC systems that you're putting into your own home. If you're going to have any of that work done, do it before December 31st, 2025, because those are some pretty good sized credits and they will be gone in 2026. And the reasoning for that is just if you go out and try to purchase something now, it's all energy efficient. You'd have to go out of your way to try to get something not energy efficient. So the administration is just saying, okay, those tax credits have run their course. So those are a couple of negatives that I wanted to point out here. And I think hopefully we still have some time for questions.
Yes, thank you so much, Joel, and thank you, Gina, for all of that great information. Gina, I see you replying in the chat here if you want to come off of mute and respond to this first question that we had come in. Can you explain what information/documentation is unique for Michigan's R&D initiative and whether there's overlap with the federal tax credit?
Yes, thanks for that question, Francine. There's a lot of overlap. What's unique at the state level, so most states offer a research credit. Ohio, Indiana, our neighbors all offer it. So in Michigan, similarly, you will need to document essentially the activities that took place in Michigan. So only Michigan payroll. As far as the documentation, it will be very similar in that you have to show how cost relate to specific projects. And it's an actual application as opposed to a form that gets submitted with the federal tax return. You're actually going to be submitting an application. So that I haven't seen the actual application yet. So that's a good follow-up for us. When that comes out, we should push that out to everybody. But essentially the documentation is very similar as the federal credit.
Thank you for that clarification. Any other questions for our speakers today? I know this was a lot of information to digest. As I mentioned, this is being recorded, so we can send the link to the recording out for your viewing at a later time if there's anything you missed and you need to go back to. I'm also going to drop contact information for both of our speakers here in the chat, and they're provided on the slides as well. If you maybe think of something later on. Gina had also suggested maybe doing a second version to talk about some year-end planning items. So that's something that we'll be considering in the next few weeks. But as we wrap up here, I just want to give another opportunity for anyone to ask a question before we end our time together. All right. Well, it looks like no questions. So you guys covered all of that information beautifully. Oh, just one here
Oh, I
coming in
see.
at the
Yes,
last
I see a
minute.
question. Yeah,
Yes. Are the corporate tax savings only applicable to manufacturers? We are a wholesaler.
No, I think when I think corporate tax savings, really those expensing provisions, those would still be available to a wholesaler. I'm trying, perhaps it will depend on also the type of entity, whether you're a C corp versus a flow through entity. So keep that in mind. But no, I don't think of a wholesale necessarily as being, oh, even better as a C corp. So I don't think of a wholesale sailor being excluded from any of those provisions. I don't know, Joel, unless you think differently, but I don't see
Nope.
any of those provisions causing a problem as a wholesaler.
Yeah, I agree. I think all of those will apply.
Great. Okay, last call for questions. Got a question here regarding tax revisions for educators. Does this also cover those in post-secondary education as well?
Yes.
Great.
Yep. Any education field, yeah, you just want to track. I mean, it cannot be reimbursed. So if you're, if the facility you're working with reimburses, then that would be different. But other than that, keep your documentation for any costs you have.
Very good. Thank you. All right, well, we're coming right up on 1 o'clock. We'll stick around for a few minutes if anyone wants to hang back and ask additional questions. But with that, we want to thank our speakers today, Gina and Joel, for all of their expertise and wisdom. Be on the lookout for a follow-up email to your guys' inbox by the end of the day today. And if you have any suggestions, comments, questions, feel free to reply to me directly. And one more time, I will drop their contact information in the chat for you here. Thanks so much for joining us.
Right. Thank
Thanks,
you.
everyone.
Yeah.
All right, it looks like we're all set. Thanks so much, you guys.
Thank you, Brianna.
Thanks. Yeah. Thanks for